and welcome to the CNBC-TV18 Newsroom. I'm Ekta Batra and you're joining me on your stocks this Monday afternoon. Well, joining us today, we have Ashish Kyal from Wave Strategy Advisors and Parthiv Shah, who's the director at Tracom Stock Brokers. Ashish is going to take us through the technicals and Parthiv is going to take us through the fundamentals. Before we kick off and start discussing a couple of queries, wanted Ashish's view with regards to the markets, considering that the Nifty has just gone from strength to strength today. The Bank Nifty has come back in full force and it's up around 1.7% as compared to the fall that we had seen in Friday's trading session. So in that context, Ashish, wanted your thoughts in what is quite a strong start to the week.
Absolutely. Afternoon to you and all the viewers as well. We can clearly see Nifty trading near the day's high, and even Bank Nifty has recorded most of the losses it showed on the Friday session, which is a positive sign. And Nifty managed to take out the 18,270 level. There has been a huge, put build-up that we can see at around 18,200. So that is going to act as a support. So I think the market is poised for much higher levels from here. We might be headed towards 18,500 from here on. And on the downside, use any dips towards 18,200, 18,170 as an opportunity to enter the trend. Do not try to catch a top in this market. It looks very, very strong, and the rally is broad-based. If you look at the sectors, if you look at sector rotation is happening, and the rally is broad-based, everything is participating. Mid-cap, small-cap stocks are also participating. So it's a healthy sign for now. I think markets are headed higher.
Okay, you think markets are headed higher from these current levels? We do have the Indian Bank numbers on your screen, where the net profit is up around 47% on a year-on-year basis to 1,447.3 crores. This compares to 984 crores on a year-on-year basis. As you can see, the stock has recovered from the day's low, and you can see a spike up on an intraday basis. The NII too is up close to around 30% on a year-on-year basis. So good going for Indian Bank in terms of performance. We'll wait by for the asset quality and whether or not there is any kind of significant improvement or sustainability which has come through for Indian Bank when it comes to asset quality, as well as the details from the presentation. But as of now, looks good, at least in terms of the NII as well as profit. Parthiv, before we move forward, any view on Indian Bank and a lot of the PSU banks that have released numbers?
Yes, good afternoon, Ekta. Absolutely, I would say a very good set of numbers. And like we have seen in plethora of PSU banks, there has been good improvement in the credit cost. The net slippage ratios have started to come down. We are seeing better NPA levels, and more importantly, I think the guidance, especially coming out of a lot of the conference calls of the PSU banks, is quite strong. And after a very long time, we are seeing them disbursing more loans, and the credit growth is almost to the tune of anywhere between 10 to 14%, which is reasonably healthy. And except for some cases, there's some miss in terms of the NIMs, but overall the NIM quality is also pretty good. So operationally, I think these banks are doing very good, and the provision coverage ratio, even till date, is extremely strong. So Indian Bank also, if you see year on year, quarter on quarter, I think fantastic set of numbers, and I feel that these banks are quoting really cheap. The credit quality has improved a lot, and going ahead, I think such numbers could be sustainable, which could help them to re-rate from here.
Okay, all right. So maybe these numbers could be sustainable going forward. But let's get into some queries then. We have a lot of questions to be answered, and what is a very lively market? So maybe a lot of stock-specific queries this afternoon. First up, we have Mayank Kumar, who writes to us from Mumbai. He holds 20 stocks of Ultratech Cement, which he's bought at around 5,000 odd rupees. And he's got around 40 shares of Ambuja Cements, which he's got at around 250. He wants to know what to do, whether he should remain invested or sell his holdings at current levels. Well, both cement majors, what would you recommend, Parthiv?
See, Ekta is doing extremely well from the entry points, and both the stocks in the cement sector are market leaders. And of late, what we have been witnessing is that there are new capacity additions coming out, and more importantly, I think as compared to more of the margin protection, we are seeing these players increasing the volume share. So we are seeing a fantastic volume growth happening, and these are very efficiently run companies. And thanks to the fact that the input costs like petcoke, power and fuel have been slightly coming down, I think they've been taking advantage of the previous cost-cutting measures, and they've been saving at least to the tune of 200-250 per ton in terms of the cost. And despite the fact that we are heading into elections going ahead, I think it is looking very difficult that they'll have more pricing power because any price hikes that were taken were rolled back. Nonetheless, I think thanks to the fact that the costs are coming down, we are expecting these companies to deliver sustainable 1,000 plus EBITDA by ton, and with the new incremental capacities coming up and with volume growth, I see a reason that even from here, these companies could re-rate further. So certainly hold on, at least hold on for the next 2 years. The cement pack is looking good thanks to a lot of government spending taking place, which will drive the growth, and also the residential housing is strong, which will also drive growth in the sector.
Okay, well, those are the Indian bank gross NPAs, and there's been an improvement which has taken place both in the gross as well as the net NPA. So the net NPA is a sub 1% figure, it's coming at around 0.9%, and we have the gross NPA which has improved to, I think I saw around 5.5% versus over 6% on a Q-on-Q basis. So maybe that should come up for you as well. As you can see, the stock has in fact turned into the green post the asset quality figures which have been released by Indian Bank, and is showing actually a good performance. As you can see, the stock is at the high point of the day, showing buying at these levels. So that's the view coming in, or those are the numbers rather coming in from Indian Bank. But let's get to another query then. We have Atul Kumar who writes to us from New Delhi. He holds 100 shares of PNB Bank which he's bought at 40. He says that though he is making a minor profit, he wants to know whether he should exit and invest in some more profitable stocks within the same space, such as State Bank of India. Interesting question there, considering that the cycle has turned for a lot of the PSU banks, and you can see it on your screen with Indian Bank as well. So Ashish, in that context, technically, what would you recommend on PNB? And Parthiv, I'll get to you just after that on a fundamental view.
See, I think his investment is at 40 and the stock is quoting above 50 rupees. So I think he's not making just some profit, he's making a good profit here. There is no reason for him to exit Punjab National Bank, because we can clearly see it has started the next leg on the upside, possibly a third wave on the upside, and the trend remains positive. So use that, keep on holding it as long as on the downside. I think 48 levels are intact. But yes, he can diversify across to SBI, because State Bank of India is also showing a very good momentum, and the chart looks promising. So maybe book half profit from PNB and diversify into SBI so that his risk get diversified, and he has taken something off the table as of now.
Okay, all right. Well, that's the view coming in. Parthiv, what is your fundamental view on PNB?
Ekta, PNB after SBI is the second or the third largest public sector bank in terms of the asset size. No doubt it had a lot more legacy loan issues as compared to likes of Bank of Baroda and SBI. That's the key reason why the stock is languishing here and has not really massively re-rated like many of its PSU peers have. But our sense is that a lot of cleanup has already taken place. A lot of loans are provided for, and going ahead, I think the bank has adequate capital adequacy. So we are expecting that going ahead the numbers will improve, and thanks to the fact that it's quoting at almost like 0.7 times price to book multiple, there is a scope with its balance sheet size for it to get re-rated. So I do agree with Ashish that no harm holding on to this one. There is better alpha to be made here as compared to the bigger names like SBI.
Okay, all right. So that's the view coming in on PNB as well as State Bank of India. Let's get to another query then. Rasika writes to us from Bikaner. She holds 20 shares of HDFC Bank, which is bought at around 800. 18 shares of BPCL, which is bought at around 310, and 30 shares of Power Grid, which is bought at around 220. Long-term investor wants to know the future prospects of her investment. So it's more of a portfolio question that we have in this case. All of these are heavyweight, large cap stocks that we're talking about. So what would you recommend, Parthiv, on a longer term basis for all three of these counters?
See, first in HDFC Bank, I think it's a fantastic entry price, and more importantly, we know that a lot of corporate action is taking place here. Going ahead, it's going to get merged with HDFC Limited, and after which it's going to be a behemoth, and more importantly, it will take some time for the synergy benefits to pan out, but again, I think that's going to be fantastic. The management does attribute the fact that they have a lot of runway in terms of improving the digitization. They are going to spend a huge capex, and that capex will be spent very efficiently post the merger. So the synergies will again benefit there. And in terms of valuations, I think thanks to a lot of time correction that has taken place in HDFC Bank, it's not necessarily expensive as compared to its previous 5-year valuation average. So we are very comfortable suggesting to hold on to HDFC Bank here. BPCL, I think generally we are not big fans of oil marketing companies, but knowing the fact that crude oil has settled and the government seems to be in the mood to allow these oil marketing companies to make some good marketing margins, I think these companies are going to benefit of this trend. But I think as compared to BPCL, we are preferring IOCL because IOCL also has a fantastic refinery business. It's a very complex refinery, which can also add to the earnings per share. So IOCL will be preferred over BPCL. And the last one being Power Grid. Again, we know for the fact that this is a near monopoly in terms of transmission and distribution assets. It's a fantastic cash flow generating asset. They've been having a good trend of increasing dividends as well. And again, quoting very cheap at 1 price to book multiple. I think that's a good asset. It will get re-rated going ahead. So certainly hold on to this.
Okay. All right. Quick technical take, Ashish, on these 3 stocks.
See, if you look at the overall movement of HDFC Bank, it has we can see some gap down opening, but that is because of the rejiggling which is happening. But I think the overall stock looks very good. On the upside, it's an opportunity to possibly buy more if he wants to, and we can expect a target on the upside towards the level of 1800 in HDFC Bank, as long as on the downside 1560 is intact. As far as BPCL is concerned, we can see a lot of volatility. It has gone up from 325, gone towards that 370, 360 mark, again went down to 330. So the volatility is high in BPCL, and we can clearly see over the period of last 1 year, it has not given much of a very strong return that we can see from the other stocks. So my advice would be currently hold on to BPCL, maintain a stop loss on the downside at 350, just in case the stock move back below that 350. It's better to be out from this and diversify into SBIs or HDFC Bank and those stocks. And as far as Power Grid is concerned, the momentum is still picking up on the upside. Clearly, a very strong breakout has happened about that 238 mark, which was acting as a major hurdle for most of the occasions. A very strong breakout that we can see on the charts. And the sector looks to be good. So continue to hold on to Power Grid. The target can be around 280 levels. And on the downside, the support for the stock is at 230.
Okay, all right. So that's the view coming in on all of these portfolio stocks. Well, we need to take a short break with the news that the markets are in fine fettle. We have the Bank Nifty, which is up a cool 700 odd points. So it's recovered all of those losses that we have seen. The mid-cap index, which is up over 300 odd points, and an advanced decline ratio, which is holding steady at over 2,000 stocks advancing and around 1,600 stocks which are declining on the Bombay Stock Exchange. Take a break. More queries on the other side. Welcome back. Well, let's get to a couple of more queries that we have this afternoon. Sonal Jain writes to us from Chandigarh. She holds 50 shares of Infosys, which she's bought at around 1,000 odd rupees, and 40 shares of Tracom, which she's bought at around 500 odd rupees. She's considering what to do, considering the disappointment that we've seen in terms of the Q4 FY23 earnings, especially from the likes of Infosys. Well, Parthiv, we at least feel 2 questions every your stocks on the IT space, because that's so much of a concern. It was such a darling, and now there are so many questions with regards to a slowdown when it comes to recession. What could artificial intelligence do to the fundamentals? And obviously, the earnings were disappointing as well for the likes of Infosys. So in that context, what would you recommend to somebody who's a long-term shareholder in IT stocks?
See, absolutely, Ekta. I think one argument a lot of people were making in the IT sector was that it's a defensive sort of a sector, very resilient. But again, everything is looking defensive and good at a certain valuation band. And a lot of these IT companies, thanks to a lot of positive commentary in terms of the structural growth story, that was a consensus commentary from most of the managements. I think the valuation band had gone a lot higher, almost 20-30% higher than the normal averages. And what we saw is this huge macro headwinds coming from the US and the European markets. And now all of the sudden, we are seeing the commentaries looking very weak. And they are talking about structural problems, macro issues. No doubt some of the key managements like of TCS, Infosys are talking about the fact that going ahead, I think things should improve. But again, we have witnessed a massive correction in this sector. Luckily, the investor, I think, totally depending upon the time frame that she's willing to hold on to these stocks too, her entry points are pretty decent. And I really doubt that despite all this negativity, and especially after a massive correction that we have seen in likes of Infosys and that of Tech Mahindra, I think there isn't looking like a much downside from here. Nonetheless, I think if the time horizon is upwards of 2 years, I believe that these are the good levels to hold on to. These are massively free cash flow generating companies. They do a lot of buybacks, enhance shareholder value, ROEs are improved, and plus they also give a lot of dividend. So no harm waiting into these stocks at these valuations, especially if the investor has a 2-year plus time frame.
Okay. All right, Ashish, what about you? Technically, how would you approach a couple of these IT stocks, considering the likes of Infosys is still hovering close to its 52-week lows?
Yes, we can clearly see there has been a very sharp fall in Infosys stock, and post that it is not showing much of a recovery sign. But on the contrary, if you look at the mid-cap IT's names and something like Sand, or if you look at stocks like Persistent Systems and on many other IT names, Datamatics, you can clearly see most of them has performed exceptionally well. So I don't think it is the question because of the AI, this large cap bellwether are going to face issues, because it's anyways going to get more efficient and their things will span out in a much better way. Who knows? So I would say that I think the IT space, the IT sector as a whole is going to turn up. It's going to outperform. It's only a matter of time that some consolidation is possible in Infosys and Tech Mahindra. Both of these stocks can consolidate for some time and eventually should move higher. So I don't think investors should be worried about the sector as a whole or about the stocks, because these are good levels. If you want to enter, maybe average out more at these levels. And for Infosys, the support on the downside, very important support on the downside, is going to be at 1180. As long as that is intact, the first target we can expect is 1380, which is the gap area. And for Tech Mahindra, again, multiple supports it has taken around that 980, 960 levels. It has been months that it has protecting that level and bouncing back from there. So I am expecting Tech Mahindra over short term should bounce back towards that 1140, 1150 levels. And once it breaks that consolidation zone, up move can be expected in Tech Mahindra, even crossing about 1300. So hold on to both of these stocks, maintain stop loss if you are anxious about it. But I think IT sector as a whole is going to outperform.
Okay, all right. So you're positive on the IT sector, and Parthiv's view also was quite positive on the entire IT space. So let's see whether there's any sort of comeback from these levels. But let's get to another query then. Rahul Jain writes to us from Patna. He holds 50 shares of LIC, which he's bought at 500, and 40 shares of Zomato, which he's bought at around 50 rupees. He's a medium-term investor, wants to know what to do, whether the new age stocks get better from their current levels. So we have both of them currently making money for him, but nonetheless not significant returns as of now. So in that context, Parthiv, what would you recommend on both these stocks? LIC is old age, but Zomato definitely new age.
Yeah, a good one. So in case of LIC, unfortunately, ever since the listing, it has been dismal in terms of performance. And, despite the fact that they have been talking about improvements in the value of new business margins going ahead, I think the street is not still excited. And more importantly, it's one of the cheapest life insurance stocks on the listed space, despite being the market leader. It's quoted at around 1.1 times price to embedded book value. So basically, our sense is that it will take a lot of time. They will have to show quite many quarters of market share sustenance, if not gaining, because they already have a huge market share. And of late, the numbers reflect the fact that the private sector companies have been stealing a lot of market share from likes of LIC. So they need to sustain their market share. Not only that, they need to improve the return ratios. So I think if something of that sort were to happen, then there is a scope of re-rating. It will take some time. So I think if the investor does not have a very long-term horizon, it's better to switch into some privately run company, something like an HDFC Life or for that matter ICICI Life. They look a lot better here. In terms of Zomato, I think a lot of discussions are happening these days in terms of the competition it faces with the open digital network, and more importantly, I think it's very important to see as and when the ONDC were to spread, what sort of impact does it have on Zomato's gross order value. If that were to decline, I think then that's something that could spook the valuations of the company. Already the stock has run up from the lows, and there are talks about it wanting to be profitable over time. But our sense is that there's a lot of disruption happening, so it's better to avoid such companies for investors, especially retail investors.
Okay, all right, Parthiv as well as Ashish, we're going to wrap it up on that note. Thanks very much for joining in and taking us through all of those questions that we have on this Monday afternoon. That's all the time that we do have on this show, but do remember you can email us your queries and we will address them with our experts. Stay tuned, closing bell to take you through the last hour of trade.